Hello. Okay, my name, should I start? Yes, I'm Madison Condon. I am an associate professor at the law school, and I research climate change and financial risk and how to regulate it and what to do about it. So this has been a growing issue. Excuse me. It's been a huge international issue in which there's this thing called the Network for Greening the Financial System, which is mostly a coalition of central banks, European banks, China, Mexico, a lot of East Asian banks. And for the past 3 to 4 years, they've really been ramping up the ante. They've been implementing a lot of different climate change oversight, regulations and stress tests and scenario analyses and disclosure rules. And the US was sort of mostly out of the game until the Biden administration came in. And there was this executive order on climate-related financial risk issued in May 2021. So now every financial agency has a climate risk oversight mandate, and they're all in different stages of regulatory rulemaking. The most contentious and famous one that's been covered is that the Securities and Exchange Commission is going to require mandatory disclosure of climate risks from all publicly traded companies with different categories for different sizes of companies. And it's very contentious here, but pretty much becoming standardized in a lot of other markets. So it's interesting to think about the ways in which it will or will not matter if the Supreme Court kills the rule, which it has indicated that it probably will. Separately, the Federal Reserve, which is not covered by this executive order because it's independent, also joined the Network for Greening the Financial System. And in January of this year, it released its pilot climate scenario analysis for banks to report against. So it's asking banks to report their present day portfolios against future scenarios of risk. In the climate financial risk world, we talk about climate risk being mostly litigation, mostly transition risk or physical risk. So transition risk is stranded assets, the idea that you have thought an oil field would be profitable, but it turns out that people decide to care about climate change and now you can't sell it. And that asset becomes stranded. Maybe the company goes bankrupt. And there is this like story and narrative that could lead to a broader systemic risk. I am more of a physical risk person than a transition risk person, even though I do think about the transition risk. And, you know, one overarching narrative of my research is that people need to pay more attention to physical risks, and there's been like an oversized focus on the risks of transition as a financial risk. So I think about why climate change is particularly challenging for markets to get right and respond to and adapt. And there's really a bunch of different reasons, but the key one is that the future is going to look very different from the past. And we designed our institutions in a lot of different ways for it to not be like that. So one, we designed a lot of corporate buildings and infrastructure for certain design standards that are meant to withstand certain extremes. And it's not really clear in the like financial world whose job it is to figure out which of the existing infrastructures are now exposed to risks that they were not exposed to before. Meaning we are used to, or like our business leaders are used to relying on insurance products to price these types of risks often. But the problem is that there's a duration mismatch, meaning insurers can reprice their insurance premiums every year, but people may decide to go forward with various capital projects that they just sort of think that the premium this year will serve as a reasonable proxy for the risks all the future years, because that's the way they were trained to do their job. And that's just not the case anymore. And so we sort of have an institutional structure where the insurance companies are the ones that know the most about the risk, but they're under no obligation to tell anyone any information beyond the price of their current premium contract. That's one problem. Another problem is that in the financial market, extremes really matter. And a lot of wow, I have 1 minute, okay. So extremes really matter. Global climate models, the science ones, are not so good at predicting extremes. They're very good at predicting averages. They were not designed to predict typhoons. And it turns out that the rare, really bad heat wave is one of the things that matters the most for financial markets. And it's not clear that all the businesses in this space really understand the science behind what they're marketing. They don't really understand the data products that they are selling, and it's becoming a huge business. And it has serious consequences. So how Moody's goes about rating financial risks for Miami's bonds actually has implications for how Miami prioritizes different resilience projects. And this is a very low oversight area, very not enough training. The models are not good, frankly. And so I propose a lot of different regulatory interventions and like how financial regulators could handle this. One problem is that financial regulators also don't know what they're doing. So this is a climate scientist who wrote this blog, but we're friends on Twitter. But the Federal Reserve's climate scenario analyses basically ask banks to, a thing that science does not know, a certain type of large hurricane on the East Coast in 2050 under 2 different emission scenarios. That is not a thing really you can ask. You can ask lots of different other things that the Fed does not ask that we know is going to happen and really could have systemic consequences. So I'll end. And that is, we know that there are risks that we know about that we don't see reflected in prices. And we know that municipalities, for example, like raise revenue based on these property prices, which will reprice eventually. And so when we're talking about systemic risks, this is the type of thing I am talking about, sort of cascading failures, both physically and financially, when there's insurance failures, for example, like in the South, in Louisiana and Florida. And it's becoming political, and it always has been, I guess. Maybe that's what I'll say.